Hey everyone, thanks for joining us. We have Graham, Rajul, and Arjun on stage with us. So I'm gonna start with a very quick introduction about everyone, and then I'm gonna leave the stage to these guys. So Graham is the partner at Senena Ventures. Senena focuses on emerging fund managers, and they back some of the great emerging fund managers across the globe, and also in India. Again, Senena's one of the portfolio companies, Leo. So we have Rajul here. He's gonna share more views about how he helped, what it was for him to get Sendana on board. And next we also have Arjun. Arjun is from Special. Special is a deep tech and SaaS focused VC fund, one of the top performing deep tech focused fund. So I'm gonna leave the stage to these guys. And Leo Capital is also a multi-stage fund based focusing on India, and they recently launched their Europe fund. I'm gonna leave the stage to these guys. Graham, why don't you start with a small introduction about you?
Yeah, sure thing. Pleasure to be here. Really appreciate the time and look forward to the conversation. Um, I think I was asked to just give a brief background on myself. So I'm a partner with Sedona Capital. I have been on the institutional limited partner side for basically my whole career, starting in the early 2000s with Cambridge Associates. So if you're not familiar with CA, they're one of the oldest investment advisors. I worked with some clients with really meaningful non-marketable exposure. So did a lot of venture capital fund selection. Um, I was based in Boston for those years, and then moved out to San Francisco and joined another fund to fund called Horsley Bridge Partners. So spent a few years in the Bay Area with Horsley, um, and really that was around the advent of kind of seed as a distinct category. So had the privilege to back some of the early funds in that space, like Mike Maples at Floodgate and Steve Anderson at Baseline. And then I moved to London for a year to cover mostly Europe and Israel, but actually that was my first trip to India, and taking a look at the kind of Indian venture capital ecosystem and landscape, um, and got my MBA. Tried my hand at operating, but was never meant to be an operator. So came back to the investment side of things. Joined my partner Michael more than a decade ago at Sundana. So we are a pre-seed and seed venture fund investing globally. We've been around since 2010 and are currently deploying out of our sixth vehicle. We launched our international program back in 2018, and it really was meant to be an extension of what we do here in the U.S., which is look for the very best small early stage venture funds. And we feel like we've found some really exciting partners around the globe. Happy to talk more about how we thought about India. But let me turn it over to I guess Rajul to give a little bit of his background.
Thanks, Graham. I think great to be here, and good evening, good morning to everyone wherever you are. So I think just a brief background. I'm an operator turned VC. So was a founder for a good 17 years. Did three companies back to back: Pine Labs, large payment company; Global Logic, and then Sunstone, a tech company. My first two companies were invested in by Sequoia India at the time, now called Peak 15. And I worked with them briefly between my second and third venture and got a taste of venture. This is 2013, 2014. And then eventually started investing my own capital as Indian venture ecosystem was growing from 2013, 14 onwards as an angel. So made a bunch of investments, started enjoying the process. Also saw the gap in India of an operator VC fund. I think Indian entrepreneurial ecosystem is still relatively new. And I think now there are more and more operators turning VCs, but it wasn't the case a few years back. So I saw that gap and thought it might be a useful thing to do for the ecosystem and a fun thing for me, and hence started Leo Capital in 2018. We're an early stage operator VC fund. I think earlier, Pavitran said we're multi-stage. We're actually not multi-stage. We're very focused on just seed. But we are got a little bit multi-geography. Historically, we've been investing in India, US, and recently we've just also started investing in Europe, but very much focused on seed, pre-seed, sometimes pre-A, and working hard with these companies. We've been fortunate to have Sandana invest in us actually for now a good 5 years or so. I think we first met them in 2019. I have to say it's been an absolute privilege working with them, and I'll let Graham speak more about what they're up to today. But we've enjoyed a fantastic relationship with them, and they've been part of multiple funds in our case, and we continue to grow our franchise and hope to invest in more and more companies as the time goes on. So let me pause there.
Great. No, lovely to be here. Thank you so much, Pavitran, and great to join this panel along with Graham and Rajul. I'm Arjun, founding partner at Special Invest. We're an early stage pre-seed seed focused deep tech fund based out of Bangalore and Chennai in India, and now operating close to 8 years. Since 2017, 2018, onto our deploying Fund 2, hope to launch Fund 3 next year. My own background, I've been a product builder slash operator for about 15 years before I started the fund. Worked at early stage startups, and then co-founded 2 startups myself between 2009 and 2016 before we started Special. In the tech enabled, first company was in SaaS, second company was in online travel, right? Raised a few rounds of venture capital, scaled it to a reasonable degree. So saw the 0 to 1 journey fairly intimately over a long period of time, and that is sort of one key pillar and passion of mine and ours at Special, to work with founders very, very early when they're typically at idea stage. I would say 90% of our companies don't have product, pretty much 100% don't have revenue when we invest. So we're very comfortable with that early stage. And we like to stick to that thematic. The other variable, which is deep tech, is a very exciting term today, fast emerging and more mainstream than it was when we started. We strongly believe that the next decade and 2 decades, 3 decades from India will be about building cutting edge IP driven products and technologies for Indian markets and global markets. And that thematic we have tried to stay true to. Invested about 40 companies over the last 2 fund cycles across a variety of sectors like space tech, robotics, EV, battery tech, cloud. More recently, looking at biotech, life sciences, and semiconductors as well. Of course, there's a flavor of enterprise infrastructure software as well thrown into that mix. But very exciting times. We largely have domestic LPs, HNIs, ultra HNIs, family offices, starting to have conversations with fund of funds. We've interacted with Graham and the Sandana team, have immense respect for them. And we learn a lot through their, what content they put out publicly. And, that's also an exciting aspect to take a look at on the global side, right? That's a little bit about Special.
Wonderful. Thanks a lot, gentlemen. One of the things we were asked to talk a little bit about, at least from my vantage point, is how we think about manager selection. And this is universal for Sandana. There are some nuances, I think, for non-US or more emerging markets. But we have a couple different kind of vectors that we use as we evaluate funds. And the first one is really around portfolio construction. So we care a lot about how venture funds are building their portfolios. We bias towards fairly kind of hands-on, high-touch, high-conviction approaches, which we believe leads towards kind of more concentration than maybe the broader portfolio approaches, where you're writing small checks as an option to see if something inflects. We look for funds that I think are a little bit more involved in their startups, which we think kind of naturally limits bandwidth and the kind of total number of things that you can get involved with. And I think because we look for funds that are working closely with their companies, we believe they should be rewarded for that. And we look for funds that are fairly thoughtful about ownership, and in particular, ownership relative to fund size. So I don't think we think about entry ownership in a vacuum. We think about it in terms of how big a vehicle you expect to deploy. And kind of a rule of thumb that we use is, approximately 10% of your fund size as kind of a nominal average entry ownership is a pretty good indicator. So a $50 million fund, if you're consistently getting 5% entry ownership, what we've seen is that is kind of market across our portfolio. Now, some of our better performing funds have actually owned more than that ratio. Because if you do find an outlier, obviously that drives meaningful outperformance if your ownership relative to your fund size is substantially higher than that ratio. The last thing I'd say about that, and then we'll turn it over to Arjun and Rajul to think about how they've thought through portfolio, is like, I think for non-US markets, we tend to bias towards even smaller funds with kind of that ownership to fund size ratio pushed even a little bit higher. So I think we acknowledge that there is some exogenous risk in non-US venture markets, and we feel like you should be rewarded for that if you do successfully find some outliers. So what we tend to see in our international portfolio, and I would say especially in more emerging markets, is that ratio tends to show a little bit higher than what we might see domestically for a standard US seed fund today. So curious if you guys have any thoughts on portfolio construction, if that resonates, or if there's anything you think is different from kind of the Cendana perspective.
Maybe I can go first, Graham, and since the topic is called attracting global LPs, and all of our LP base is ex-India, so we have a few asset managers, and of course fund of funds like yourself. We have a couple of sovereigns, and a bunch of others. So I think what we found was that I think a big part of attracting global LPs is to understand their thesis and plug into that. And I think US particularly is a lot more sophisticated about it, just because it's older. I think in places like India or even Southeast Asia, Europe, VC is still an emerging asset class. And I think many LPs may not have as much clarity or experience with the asset class as US LPs do, whether they're endowments or like Cendana or fund of funds and things like that, because they come in from deep experience. Like you were at Cross the Bridge, Michael was earlier at SVB and things like that. So you guys have seen the asset class emerge over decades, which I think is important in this business. So I think so. Some of this portfolio construction stuff that you talked about is really based in data. I mean, it's simple math. I think as a fund, you can do more investments, which are and take smaller ownership, or you can do fewer investments and take greater ownership. We are definitely in the latter camp. And our experience across now 3 funds, especially as the first fund has come to maturity, is exactly that. I think our biggest winner in Fund 1 is now, we're holding it at almost twice the size of the fund, and simply because it was just, we had a deep ownership when we started. If we had like a third of the ownership, our sort of current performance of that fund would be significantly different from what it is today. And and even the smaller acquisitions, we've had a couple of acquisitions in our first fund, and even they moved the needle for us, even when they were small acquisitions, each of them for $30 million each, odd. But because we had a deep ownership, it still returned a somewhat meaningful amount of money to us versus I think if you had very small ownership. I think when you do the math, I think it's much more useful to do the math of returns at a fund level versus individual level. Sometimes I've heard managers say that this opportunity can return us 5x or 10x, but on a seed stage fund, let's say if you're deploying a small amount of money, then even 5 to 10x may not move the needle on the fund, even though it looks really attractive, as an individual investment. So it's useful to think of, what that investment can return as a multiple of the fund, and not individually. And then when you do that math, then I think ownership becomes absolutely key, and that's been our experience as well.
No, great points, both of you. I think I'll share a little bit about the approach we took. Obviously, we're formalizing in the portfolio construction aspect. I think we were fortunate to pay attention to that early on, but we've gotten more sophisticated and more measured about a lot of variables within it over time as we're understanding, and we're deploying more capital and seeing more companies. One of the things that we thought of very early on, and again, to reiterate, we are pre-seed seed, so we're coming in super, super early. And the general consensus or the market consensus was that, hey, that's an extremely high risk stage, and therefore you need more diversification, right? But I think to Graham's very initial point, we took a very specific view that we think by very deliberate effort and time spent and intervention with these super early stage companies, right, which therefore meant we had to allocate more time from our side towards them, right, we could meaningfully change the risk profile of portfolio, right? That we could move the needle from what say is a market 10%, success rate at that very early stage to maybe 15%, 20%, 25%, 30% by our approach to working with them, our intervention with them. How do we help them with aspects of reducing risk in the early stage? And hence, to balance that out, by default, if we are a two GP fund, right? There's only so many companies that we can manage given our 24 hours in a day and the fund life cycle, etc. Correct. So we went with a sub 20 company portfolio in our fund one, and we're replicating that in fund two and in fund three, right? Which usually we have heard from the market to be 30 companies, maybe 40 companies needed at pre-seed because the risk is very, very high. So the mortality can be high, right? So our diligence process and our approach, the bar is kept very, very high. We're only doing 4 or 5 deals a year. We're also deploying this over 3 to 4 years, not doing this in 1.5, 2 years. That's the other variable, and we'll talk about that a little more. And therefore, between two GPs, we're each managing less than just about 10 companies, right, in a fund, right? And that enables us to really pay attention, to go deep into what the company is doing, to be really aware, to be ready for interventions in terms of early customer access, in terms of advisory access, correct, on either GTM or specific geography or policy, etc. Particularly given that we're doing deep tech and emerging areas of technology, right? So that's the key variable we took. And of course, therefore, when we were coming in early, trying to lead these rounds and doing, a limited set, less than 20 companies, ownership expectations was fairly high. I think we were sub 10% in fund one, although there were outliers, which were above 15% and obviously less than 5% ownership as well. And it is now 7 years in, it is fairly clear that the, higher ownership portfolio companies, as they have matured or reduced risk, right, we are reaping the rewards, right? Again, to add a data point that Rajul also was sharing, our top performing company from fund one is one single company. We had about 20% ownership in that company, right? Weirdly, an exception that we made in terms of even the check that we wrote. A median check was about 300K. That particular check was 500K. That part is serendipity, but the ownership went up to about 20%, and that today, even after early liquidity and helping DPI, the ownership gives us anywhere between 3.5x to 4.5x of the fund, right? Which Rajul was really emphasizing upon, and that is super, super critical to keep in mind. So I think we strongly believe that a very concentrated approach and being hands-on, right, and spending time with companies and helping them on specific aspects can reduce risk, even though the stage did not necessarily, merit that in the early stage, and we're seeing early rewards of that. So we're not changing that aspect, right? We're not increasing diversification in our portfolio in fund 2, fund 3. On the contrary, we're trying to figure out how do we own higher and then hold higher. What we did not have the luxury of in fund 1 was holding on to ownership because reserves were very, very low given a very, very small fund. But fund 2 and fund 3, we're really optimizing for reserve ratios, and we should talk about that, all of us. I think that'll be helpful as we go along. So that's sort of been our experience early on.
Wonderful. Yeah, super interesting. I think that kind of the nuances of portfolio construction are fairly universal. I mean, there are some specifics that are maybe a little bit more regional, but like it's kind of an academic exercise as we talk to fund managers anywhere around the globe. It's a similar discussion. I think the second lens that Sandana uses as we evaluate strategies is a little bit more kind of geo-constrained, and that is like, how do we think about an ecosystem and whether it can deliver compelling returns for a seed venture strategy? And we think there are a number of ingredients that an ecosystem has to contain in order to be successful. And that's great founders and entrepreneurs. That is enough talent to scale these companies. That's enough downstream capital to support those companies as they grow, and then ultimately, the right access to exit markets to generate liquidity. So, that was a big consideration for us as we thought about, India. Did we believe that the ecosystem was mature enough to support a dedicated seed strategy? Obviously, ultimately, we came to the conclusion, yes, as we supported Leo. And I think, a lot of the aspects of our evaluation hold true today. We continue to believe in the kind of macro story and the tailwinds associated with a lot of the Indian growth story. Obviously, great technical talent, highly educated populace, emerging middle class, et cetera, et cetera. I would say the one thing that we paid a lot of attention to was, was there enough local downstream capital? And I'm really curious to hear your perspectives on how that's evolved over the 10, 20 years you guys have been involved in the Indian ecosystem. To us, it felt like it was stabilizing. There were maybe 10, a dozen local funds that would consistently lead Series A's and B's, which, part of the reason we think that's so important is when you have a kind of global pullback in funding, like we've seen around the world, all of the, not tourist capital, but the global capital, I feel like tends to retract to more stable and mature ecosystems. So a lot of the capital that was active in LATAM and Africa and Southeast Asia has pulled back to the US. And we think that ecosystems with robust local partners are just a little bit more stable because they aren't as subject to huge swings in terms of outflow. So curious how you guys have seen the Indian downstream market evolve. And then maybe, Arjun, specific to your strategy, for kind of a more specialized, like are there new and emerging pockets of capital that are supporting companies that are a little bit deeper tech? Because we have seen that part of an ecosystem mature maybe a little bit later.
No, I think makes sense. I'll just go first on the deep tech aspect, if that's okay, and then Rajul obviously can give a wider view and other stuff. So you're right. I think from the beginning, the question about downstream capital, particularly in our narrower strategy, if you will, of deep tech and IP-driven companies, where will that come from? Is that available? Because there was capital available for a bunch of other sectors that were relatively more mature. I still think we're so early as an ecosystem, right? Cumulatively 15, maybe 20 years tops, right? That every part of the ecosystem is still maturing. But having said that, consumer, fintech, tech-enabled enterprise SaaS, etc., have had maybe 2 cycles play out, or 1.5 to 2 cycles play out. While deep tech, is maybe seeing the first cycle still play out. So it was a consistent question for us. I don't think the answers are all in yet, right? What we have seen is first cohort of companies that started anywhere between 4 to 8 years ago now have not, at least the round two, round three, let's call them pre A, and maybe a B, right? Which are smaller sized rounds, if you will, raising anywhere from 5 million to 20 million. There is availability of that. Although it is not concentrated, it may be fragmented and it may have to be put together. There's family offices, there's small funds, there's boutique funds, etc. Correct? Where there is uncertainty is where do you get 25 million, where do you get 50 million, for where do you get 100 million for the real hyper growth of some of these companies. And I think we're at the cusp of figuring that out in this year, last year, this year, next year, right? Some subsectors within deep tech have attracted capital, some others there's a wait and watch. So it's a balancing act, right? I think uh, what our observation has been is that while a new category or subsegment emerges and there isn't enough clarity of how exits and liquidity for that category play out and at what valuation, so there is some resistance from follow downstream capital to put in the big bucks. But at the same time, markets can be efficient, and the supply demand part takes care of by the price being attractive for those investors that are willing to take that risk, right? So we come in early. The next round is a $5 million round. Let's say relative to a more mature sector like consumer, commerce, fintech, etc. I think the valuation uptick for founders and early investors will be slower because of the dearth of capital. Capital is available, but it's available at a little more premium price from that perspective. So that's sort of early observation, but we are also seeing a lot more nature of funds putting in capital in these sectors. More horizontal funds having a subsector thematic for deep tech. They can come in one stage later, two stage later, but still get the price of the previous round because that's the supply demand situation, right? So as a founder and as early investors, we got to bake that into the model, into the risk profile, and into how we're building the company. All right. So that's what we've seen. I think it's gotten a lot better since we started, but we have a long way to go. Rajul, you can share what you've seen over a longer period of time.
Yeah, I think, look, when we were pitching our first fund back in 2017, 2018, and since we're pitching to global LPs, especially in the US, people used to benchmark India against China a lot because China had, produced good returns from early 2000s until that time. And people track progress of local markets, local liquidity, return profiles, and all that stuff. And generally, India over a longer period of time, I would say, had overpromised but underdelivered in terms of all of those factors, just purely financially speaking, on the venture side. If I take like a 20-year view, since I've been in the industry 25 years, I think the venture markets have continued to improve. There is more liquidity. Now the IPO markets are promising. There's more money splashing around. There's more real growth and things like that. But I think specific to the question, Graham, you asked, is there enough local capital? I still think there isn't enough. It's getting better. I think now funds like Special and I know a bunch of others who have raised local domestic LP money a lot more than there used to be, let's say, even 5 years back. But still, I would say a large part of the capital is coming from global funds. If you look at, funds like the global platforms like Axel, Sequoia, Peak 15, Matrix, they're still making a large part of the downstream capital, Series A, Series B, Series C. And I think that, and in some sense, you're ultimately competing with global capital for global opportunities when you sort of raise from them, eventually. So I think has local capital increased? For sure. Is it enough? I don't think so even today. We still see sort of a lot of blips when, let's say, Tiger comes to town, or SoftBank comes to town. The markets completely change, and I think they still have a significant impact. I'm excited about some of the later stage Series B, Series C funds, which are domestically homegrown now, like A91, and then Fundamentum, which is, and a bunch of others. But I still think the local capital is still not where it needs to be able to say that this capital is only going towards Indian companies, and hence, you don't compete for global opportunities with that capital. So that would be my 2 cents.
Yep. Yep. Makes a lot of sense. Awesome. Well, given the panel is called Attracting Global LPs, I thought I'd spend a minute on maybe some considerations for fund managers locally, as they think about approaching global LPs. And then Rajul, maybe you can talk about how you kind of thought through that process, and Arjun, how you're starting to build towards that. I think one thing to keep in mind that I always like to tell fund managers when we have a conversation from emerging markets is most LPs don't have a kind of country-specific mandate. So the way that we approach non-US investing is truly kind of a bottoms-up approach. We're looking for great fund managers, but we don't kind of prescriptively allocate our non-US portfolio and say we need 15% of our capital going into India. So bear in mind that you are competing with allocation from other ecosystems. So I do think it is important to tell the story of why you think India is most compelling, even sometimes explicitly relative to other emerging markets. I mean, one of the things I think interesting about India is that, to me, it kind of sits somewhere in the middle of like the more mature non-US tech ecosystems like Europe and Israel, and the more emergent like LATAM and Southeast Asia, where the tech ecosystem has been around longer there than the more emerging. There are some signs of maturity, some evidence of wins, but obviously not as robust as like a Europe or Israel. So I think that you can make the case that it's a compelling kind of middle ground. So that's something that I don't know. I would consider emphasizing. This is more of like a tip as you think about trying to build relationships with institutional LPs, from outside of India. Is what we have found is some of our most compelling deal flow comes from our existing portfolio of GPs. And if you've co-invested with someone who has a deep institutional limited partner base from global institutions, and that fund is willing to go to their LPs and say, "Hey, look, I have this great domestic partner in India that's really helping these companies that I'm co-invested with, and they seem to have an excellent nose." That kind of endorsement goes a really long way for LPs. It's been some of our kind of highest signal deal flow. I recognize it's not easy to necessarily manufacture, but it can be an effective way to get in front of LPs. So I don't know, but Rajul, maybe you can talk about how you approached building a global LP base as you were getting started and maintaining it today.
Yeah, so I think it's definitely tough, I would say, and I think these relationships take a lot of time to develop. I think people underestimate what it takes. Many times, I think when you look at family offices and individuals, they behave very differently. They're much more short-term oriented, commercially oriented in that sense, versus the institutional LPs are usually much more longer term and fitment oriented and things like that. I think what I've discovered is that access is no more difficult. Just like, for VC funds, I think entrepreneurs can access VC funds pretty easily and get a response these days. There are many channels of doing that. Similarly, I think the global LPs are also fairly accessible. I found most of them pretty responsive. we've done a whole lot of cold email LP development, which has worked for us. We got, one of the largest sovereigns purely through cold email connect. It took 2 years after that, but that's how we initiated the discussion. So I think people are generally responsive, but I think obviously conversion takes a lot of time because they need to get to know you, you need to get to know them. There needs to be a fitment that needs to be evaluated, and all the things that Graham mentioned help. If you can sort of find other ways of building relationship through adding value, information. I think I haven't met global LPs, too many global LPs who are, let's say, dying to invest in India, and they're sort of that they're looking for India and just, the moment they find India, they would invest. I think many of them don't have that kind of allocation for India. At least most of them don't. So you really have to build up a ground up case of why you make sense and India makes sense and your specific strategy makes sense. So I think, I think a lot of persistence, relationship building. I think wider top of the funnel as well. There is a large institutional LP base out there, particularly once you go global. So I think, the more you cultivate, obviously, I remember, in fact, Michael mentioning, one of Sindana's partners, the founding partner, that, how many sort of frogs he's kissed, in the early years of Sindana building. So I guess it's no different for somebody who's raising in the US as well. But it is work. But I think, many other funds have done it, and I'm sure you can do it too.
No, I think that's great perspective. I'll add a little bit. We haven't had as much success, or actually maybe we haven't even attempted as put in that level of effort, which is very specific, which is a very important point that Rajul is making. I remember meeting Michael in 2019, right? But both our preparation and where we were in our strategy. Of course, I think we got very good and crisp early feedback saying that we were very early, right? And there was lack of clarity on some things. But after that, we did not really follow up, right? Until more recently, right? And more recently was a warmer introduction through Leo, right? So, and the other aspect is I don't think we cast the net as wide in our efforts in attracting global capital. We've been successful in getting some HNI/family office wins on the global side. Those have been relatively, simpler, right? And even expectations in, what the bar is in some sense possibly would have been lower. But that's where we found success. But I think, we do understand that the time it takes and the structure it takes to put this together, right? So, we had to have made some trade-offs saying, then we'll focus more on the domestic side. But I'm sure if we had spent reasonable amount of time, in the global LP opportunity, or top of the funnel, and then helping them through there, I'm sure we would have gotten more success in hindsight. That's for sure, right? The other aspect about whether whether the GPs are not ready or whether that particular strategy is not ready, right, is, I think articulation and presenting that case, right, is super valuable, right? Particularly to funds that are seeing immense deal flow. How do you differentiate in a very crisp, early fashion to get the right attention so that somebody wants to spend more time with you? And then you can elaborate on where you're doing differently, where you're winning, where do you have a right to win, right? You got to, in a way, just sort of think like an entrepreneur, right? Think like a founder. How do you differentiate? What makes you the best person to execute this particular strategy, right? And why does that? Why do you have the opportunity to have 10%, 12%, 15% ownership, and therefore return 5x or more of any fund, right? So I think that's been strong learning. We've gotten better over the years, but it's super critical.
Wonderful. So we have a couple more topics we can move into, but also happy to turn it over to Q&A if there are questions. Is now the right time to do that?
Yeah, Graham, we can try. Maybe what people can do is whatever questions they have, they can post in the Q&A, or raise a hand so we can bring them onto stage. So it's more.
I had someone message me directly, so let me address this one pretty quickly. Someone said, "Would love to hear more about why vintage year diversity and deploying over 3 to 4 years as opposed to 1 to 2 is important with respect to returning the funds successfully for LPs." Deployment pacing and vintage year diversification are something that are very important to us as LPs. Look, I think if you deploy very quickly, it's not to say that you can't successfully return a fund and generate attractive performance. I just think there's a lot more risk associated with that strategy. This is something that we've seen from fund managers that put capital to work extremely fast in 2021 in the U.S., really at the top of the valuation market. So they were investing into peak enterprise values that we think are going to be really hard to multiply. So the more vintage year diversification you have, the more you insulate yourself from kind of market dislocations. So not to say you can't get it right if you pick a 12 or 18-month window to deploy into, but I think if you stretch out your deployment, you mitigate that risk somewhat that you're investing at the top of a cycle.
Yeah, I think that's a good point. It's something that we have learned and tried to digest and put into the core strategy, which is, you know, are you also, maybe I'll take the deep tech lens here to say over a 3 to 4 year time horizon, we could see a couple of different technology trends that you could cover, right? Which in a shorter time frame, you may not uh, be able to capture, and that is the other possible benefit other than not concentrating risk in a very short window where pricing can be really out of control based on market dynamics, right? But the other thing is, in our fund one, we saw early wave of space technology, right? We then saw a little wave of EV, or maybe EV first, and then we saw space technology, and then we saw early signs of robotics and some other things as well. So we saw sort of three sub thematics emerge, which our portfolio was able to benefit from, right? Given that we deployed that fund over a 3.5 year time cycle, some thematics worked out, some had better tailwinds, some did not. But at a portfolio level, we were that really balanced out, and we got some wins, but none of the uh, uh, headwind or the complex sectors, they did not weigh us down because we were not disproportionately exposed to those. So that's the only add-on I'll say to what Graham was sharing. Yeah, I think there's another question on first-time fund managers. I think again, Rajul, Graham can talk about that. It is obviously extremely hard for a first-time fund manager to go out to institutional LPs and convince them of their strategies. But I think it's important to think about the long game, right? And the building relationship early and being in touch early and keeping people updated. The other big benefit that we have seen that we changed from, let's say, the first 2, 3, 4 years that we were doing, we didn't have bandwidth as well, so we were sending an annual report. But and on demand, maybe we shared some updates with our LPs, but that we went from there to doing quarterly, and from quarterly we went from there to do even monthly updates to our LPs, right? And it's not that everybody appreciated or everybody responded, but given the LP pool increased, right, just the multi cadence and maybe that discipline for ourselves and for them, right? I think we saw great feedback as we started doing the monthly, right? Was it more work for us? The answer is yes. But was the response also more positive from our LPs as we evolved and as we went back to them for more capital in subsequent funds? I think that's the other thing. So I think always keep keep your targets updated. Go early, and you might get results only in fund 2 or maybe fund 3, but that's all right.
Yeah, the only other thing, look, it's really hard to raise first time funds, as Rajul alluded to. It took Michael 2 years to raise our first fund, so we have empathy for how challenging it is. I think one of the harder things to do, honestly, as a GP, is to qualify leads in the institutional LP world. It is highly opaque, and it's hard to know who will back first time funds at all. So I would just ask explicitly as you're starting conversations, like, is this something you would consider? Because obviously time is your most valuable commodity, and you don't want to waste it on someone who's never going to underwrite a first time fund. At Sindana, we will back first time funds. We need to see some kind of prior track record, and transparently, I think for our non-US investing, we've biased towards slightly more mature track records. I think to mitigate some of the liquidity concerns in non-US markets, we've liked to see fund managers that have been through maybe half a cycle, and in some cases have even generated some DPI. That's not a universal rule. We've made exceptions, but that's how we approach it. But I also recognize it can be hard to get that answer from LPs.
Yeah, I mean, we were lucky to get Sindana in our first fund. They had a pilot program at the time, I think, and they took a pilot position, which in latter funds became a core. But it was towards the end of our first fund close, and sort of, so they were able to see most of our portfolio and things like that. So I think, so it's hard, but it's done. There are LPs who have, allocations or sort of pilot allocations for first funds. So it's tough, but not impossible. I think I'll also just quickly take, one question here around the Middle Eastern funds. So we have some Middle Eastern money. We have one actually, Middle Eastern small sovereign called TFTF. It was in the public news, so I'm sort of comfortable announcing that, last year. And I think what we've seen in the Middle East is that there's two kinds of money. I think it's either family office money, which is very similar to the Indian family offices in their mental makeup. And then there's sovereign money. So I think both Saudi and UAE have a lot of sovereign vehicles through which they invest. Even DFTF, our LP, is one of the sovereign LPs. And they have different considerations. Some of them want more local development. Some of them, want more global development. So I think you have to sort of individually understand them, but that's the biggest source of money in the Middle East, which has the sovereign funds, and there are multiple branches. And then, of course, there are family offices, which, like I said, behave like family offices anywhere else, particularly in India.
Actually, one thing that Rajul said that reminded me on the deployment period, so somewhat related. He mentioned that he was towards the tail end of deploying Fund 1, so we could see some progress in the early vintages. That's another reason, I think, to elongate deployment periods, is because your first cohort of investments, by the time you're coming back to market for that subsequent vehicle, there's enough time for them to start showing progress. And sometimes that progress is financial, so there are actual kind of markups from subsequent rounds, and hopefully attracting kind of top tier downstream capital. But sometimes the progress is simply operational, and I think that smart LPs will also take that into consideration. I mean, if you can tell a story of a company, getting to meaningful ARR in a in a couple year period, usually it's pretty clear that there's product market fit, and that that you're doing a good job identifying and getting access to attractive companies. So that's another kind of tangential reason for slightly longer deployment periods, is I think it gives you your portfolio a little bit more time to mature, and you can point to that progress as you're trying to fundraise.
Yeah, I think just top up to finish off this, I guess, subject is, and maybe now, given that we're close to raising a fund 3, which is 6, 7, 8, close 7 years into from fund 1, I think then obviously the real DPI numbers are starting to become that much critical, right? In the discussion with LPs that we're having today. And again, Rajul had mentioned this early on, some quick wins that came in the portfolio from Fund 1 that were quick M&As. They were not multi-baggers, but they were, low single-digit multiple returners. But when you put 2, 3, 4 of them together, right, that was meaningful DPI, right, at the fund level. And that was one signal, if not a very, very big signal as we got into Fund 2 and now definitely start, as we are looking at Fund 3. So, obviously cycles have played out and there have been some hype cycles and there have been some, relatively sober ones, but, the criticality of DPI is just very much apparent across, I would say, investor bases, whether it's domestic or international.
Yeah, I would echo that. I mean, look, we exclusively focus on early stage funds where all the first checks are going in at pre-seed or seed. So we recognize it's a long path to generating liquidity. I think what we look for is fund managers who are thoughtful about that process, and are fiduciaries who recognize that ultimately their objective is to return capital to their LPs. So sometimes that means, thinking creatively about ways to manufacture some liquidity via secondary. I mean, one of the things we've observed, and obviously more robust in the US than non-US markets, but as companies are staying private ever longer, and tending to raise big rounds of growth capital in the private markets as opposed to going public, there is usually an opportunity for small early stage funds to get some liquidity as a part of those transactions. So we think it's prudent for seed funds to really consider monetizing partial positions via secondary. So I think, while we don't expect to see a ton of liquidity in the early years, I think what we look at critically is, did these fund managers have the opportunity to monetize, and how did they approach that decision? Because we think that's indicative of being a responsible fund manager.
I think on the India side, we're definitely seeing a lot more secondary fund formation and opportunities emerge, particularly in the last 2 years, I guess.
Graham, I think there's a question right, from Rajiv. At seed stage, how does one balance the need for concentration, ownership, or value add, meaning not too large a fund with institutional investors having minimum check size and maximum limit on exposure percentage of total fund?
Yeah, it's a good question. I will give you my transparent answer. I think that most LPs that are dogmatic about, we have to write this check and we can't be more than X% of a fund, are probably not the right fit for an emerging manager. At least in our experience, those check writers tend not to, I mean, they use that often as an excuse not to deploy into a fund 1, 2, or even 3. So, personally, I'm not sure that that's the best place to focus your efforts. One of the mistakes we believe a lot of emerging managers make is they say, we've talked to the LP market and, X endowment says they can't write a check below 20 million and can't be 20% more than 20% of a fund. So we're going to raise 100 million. I don't think that's interpreting the right signal there, because they're not going to write a $20 million check to a new $100 million fund 1. Even if their kind of mandate prescribes a certain limitation. So I think it's better to kind of focus your efforts on people who actually support funds 1 and 2. And sometimes that's a specialized kind of fund-to-fund strategy, or an ENF that has an emerging manager program, or even a kind of maybe regional mandate. I think there are some family offices that are a little bit more aggressive on first and second time funds. But at least in our experience, like for instance, I will tell you, we don't have that. We've been 50% of a fund before. If we find something we like, we get excited about them. We want to write a very meaningful check. Now that 50% number is US. I don't know that we've done anything that large non-US, but the point stands. I think for high conviction approaches, they tend not to worry about the fund parameters as much.
Cool. I think we have time for one last question. If there's any last question from people.
I think there's one for Graham in the chat.
Yeah, sure. So this is what I was mentioning before about kind of structuring exits. What we've observed is the best time to try and sell secondary is around an actual transaction, and often if you are fortunate enough to back kind of a high growth company that is raising a Series D or E, usually there's more demand to get into that round than there is kind of dilution that the founder is willing to take. So what we've seen is that the seed funds that were in it early, maybe they've been in a company for 6-7 years, they're willing to sell 10-15% of their position to allow some of that excess demand to get access to the company. So I do think maybe this was the point of the question. It's harder to manufacture those transactions in between rounds. There is some, we have seen it happen opportunistically, but I think it's much easier to execute around a specific financing round. So I guess our advice is to just always be thinking about that. I mean, every new round to some extent should be a buy, sell, hold decision. And fund managers should think like, do I think letting this capital ride has the same chance to really multiply versus taking some capital off the table and returning liquidity or recycling it into other promising companies that are maybe a little bit less mature and have more upside.
And I just want to say that this is one advantage that smaller seed funds have, that, if you're a multi-stage fund, again, like an Axel or a Peak 15, then you're expected to ride. Like other investors really, worry if they're looking for exit from their seed positions, versus seed funds, everybody knows are small, and it's okay for seed funds to take some chips on the table, and this is an advantage that seed funds have. And I think so we've done it, and I'm sure others have done it too.
Cool. Graham, one final question, right? I think this is more on the new market trends. We recently seen this announcement about, Sendana, partners fund where you are buying some commitments of family office and new models are coming out, right? Can you tell a little bit about that here? Because here also a lot of family office and people are doing, maybe these new models can be a bit of an inspiration to other institutions and other players here.
Yeah. We launched a joint venture about a year ago with a secondary firm called Klein Hill, and the strategy is designed to buy mostly fund commitments in the seed market. Right now, the strategy is mostly confined to North America. There's a chance we open the aperture a little bit in the future, but we do think it is a big opportunity. I think there are a lot of people who ramped up commitments to private early stage funds in a market maybe without thinking about liquidity and duration consequences. And so we think there are going to be people trying to generate liquidity, and that's something that we've kind of designed the strategy to take advantage of a little bit. But I think to your point, you're going to see more and more creative, opportunistic solutions around liquidity in the coming years.
Thanks, Graham. I think that's all from our side. And thank you all for joining us, Graham, Rajul, and Arjun. And again, Graham, you're joining too early in the day. Thanks for taking this. Thank you, everyone.
Thanks a lot.
And feel
Cheers.
free
Thank you, everyone.
and join the networking session if someone is there. Some of this may also be there. Thank you.